What if the Canadian housing nightmare is finally ending, but only in places nobody expected? For years, rent only went one direction in Canada, UP. Now landlords in certain cities are offering free months, cutting prices, and watching units sit empty. This isn't happening everywhere. Toronto and Vancouver are still brutal, but in these 7 cities, the rental market is in free fall, and landlords are panicking. Number 1. Edmonton stands at the epicenter of Canada's rental market reversal. Over the past year, rents here have fallen between 8 and 12%, by far the sharpest drop among major Canadian cities. Vacancy rates have surged to 5.3%, a level not seen in more than a decade. Behind these numbers is a perfect storm, a construction boom that brought thousands of new apartments online, just as the oil sector wavered and population growth slowed. For tenants, this shift has opened doors that were once firmly shut. Listings now routinely advertise a free month's rent, utilities included, or other incentives just to fill units. For small landlords and individual condo investors, the mood is far less optimistic. Many bought at the peak, banking on ever-rising rents to cover their mortgages. Now, with rents falling and vacancies up, some face monthly shortfalls of $300 to $600, forced to make up the gap out of pocket. The pressure is especially acute for those with variable rate loans or recent purchases, as property taxes and maintenance costs hold steady even while income drops. Edmonton's story sets the tone for what's unfolding across the prairies, an abrupt swing from landlord's market to tenant's market, with real financial pain for those caught on the wrong side of the cycle. Number 2. Calgary has delivered the fastest swing from a landlord's market to a landscape defined by empty units and falling rents. In less than 18 months, the city shifted from the tightest rental conditions in Canada to a vacancy rate of 6.1%, a figure not seen here in decades. The cause is both sudden and stark. Tens of thousands of new apartments came online in 2024, just as the federal government capped immigration and international student numbers. With demand cooling and supply peaking, entire floors in new buildings now sit half empty. Landlords are responding with repeated price cuts, but new lease rents still fell by 1.3% year over year. Turnover rates have soared above 40% as tenants seize the chance to negotiate or move for better deals. For investors and small landlords, the rapid reversal is especially punishing. Many bought pre-construction units expecting endless rent growth, only to find themselves offering incentives or facing long periods without tenants. The speed of Calgary's supply shock sets it apart. Other prairie cities have seen gradual softening, but here the correction arrived almost overnight. For renters, the newfound leverage is real, and for property owners, the uncertainty is just beginning. Number 3, Saskatoon is feeling the effects of a rental market downturn driven not by oversupply alone, but by a sudden shift in student and migration patterns. Vacancy rates here are pushing above 5%, a level not seen since 2016 to 2017. The city's rental economy leans heavily on students from the University of Saskatchewan and newcomers drawn by prairie affordability. But in 2024 and 2025, 2 key pillars faltered, as international student caps slashed university enrollments and interprovincial migration slowed as job prospects plateaued. For landlords with just 1 or 2 units, many of whom bought properties expecting a steady stream of student tenants, this reversal is particularly jarring. Listings that once filled before September now linger for weeks, and incentives like free parking or discounted rent are becoming standard. Unlike the supply-driven shocks in Alberta, Saskatoon's story is about demand vanishing almost overnight. The stress lands hardest on small-scale owners, who face fixed mortgage payments and rising property taxes just as their rental income slips. For tenants, the shift brings new leverage after years of tight markets, but for those who invested at the peak, the question now is whether this is a short-term correction or the start of a longer, more painful adjustment. Number 4, London, Ontario is watching the drama of the pandemic rental boom play out in reverse. During the height of remote work and the urban exodus, rents here soared by as much as 40 to 50%, fueled by an influx of newcomers seeking space and affordability outside Toronto. Now that surge is rapidly unwinding. As new high-rise towers reach completion across the city, supply is outpacing demand for the first time in years. Many units that once sparked bidding wars are now listed at prices not seen since 2021, with some landlords quietly shaving hundreds off monthly, asking rents just to attract tenants. The return to office work has sent some remote workers back to bigger cities or out of the rental market entirely, while international student numbers, long a pillar of London's rental economy, have softened under federal visa caps. For tenants, the shift means more choice and the power to negotiate, sometimes with incentives like a free month's rent or reduced deposits. For landlords, especially those who bought or refinanced during the peak, the recalculation is sobering. With property taxes and maintenance costs holding steady, falling rents are squeezing margins and forcing a rethink of what was once considered a safe investment. London's experience stands as a case study in how quickly fortunes can change when supply and demand collide. Number 5. Winnipeg is seeing rent declines play out at the neighborhood level, where the pace of new construction has quietly outstripped population growth. In several pockets of the city, advertised rents have dropped by 10 to 15% over the past year, one of the steepest localized corrections in Canada. These are not just minor discounts. In some recently built districts, landlords are slashing asking prices, offering free parking, or including utilities just to keep units occupied. Yet the financial math for property owners remains stubbornly unforgiving. Property taxes and maintenance fees have not budged, even as rental income drops. For many small landlords, especially those who bought or refinanced on the assumption of ever-rising rents, the result is a growing squeeze. Margins that once looked safe are now razor-thin or negative. Some are deferring repairs or cutting back on upgrades, hoping the market will stabilize before their costs outpace their income entirely. Winnipeg's experience highlights how a supply-population mismatch can trigger sharp rent corrections, even in a city long known for its affordability. It also exposes the limits of relying on new construction alone to solve housing pressures. When demand does not keep up, landlords pay the price. Number 6. Windsor stands as a warning for cities betting on a single industry to drive rental demand. Optimism soared when the Stellantis electric vehicle and battery plant was announced, with investors snapping up properties in anticipation of a jobs boom. But as construction delays and project uncertainty set in, the market's mood turned sharply. Over the past year, Windsor's rental listings have doubled, pushing vacancy rates toward 5%. Rents that once seemed poised for rapid growth are now stagnant or slipping, and incentives like discounted deposits or free parking are suddenly common. For small landlords and individual investors, the consequences are immediate and personal. Some who bought at the height of auto sector euphoria are now selling at a loss, unable to cover mortgage payments as rents soften and units sit empty. The gap between expectation and reality is especially stark here. Demand has not materialized at the pace many counted on, and the influx of new rental supply has outstripped what the local economy can absorb. Windsor's experience highlights the risks of tying housing fortunes too closely to one sector, and how quickly investor confidence can unravel when promised jobs fail to arrive on schedule. Number 7. Halifax stands at a crossroads in Canada's rental market story. After years of leading Atlantic Canada with double-digit rent hikes, the city now faces a starkly different reality. In-place rents are still up a robust 6.1% year over year, but that headline masks a growing divide. Thousands of new rental units, completed in 2024 and 2025, have hit the market just as the flow of new arrivals, especially international students and young workers, slows to a trickle. Dalhousie University, once a magnet for out-of-province students, saw enrollments flatten as federal visa caps took hold. Many of the young professionals who left during the pandemic housing surge have not returned, leaving new buildings competing fiercely for tenants. Vacancy rates, once near zero, have edged up toward 4%, and landlords are responding with incentives like free rent months or reduced deposits, offers that would have been unthinkable just 2 years ago. For tenants, the shift brings long-awaited bargaining power, but for landlords, especially those who invested at the peak, the pressure is mounting. Halifax's experience captures the complexity of a market where legacy leases still reflect past scarcity, while new listings reveal the early signs of oversupply and shifting demand. The city now finds itself at a turning point, with both landlords and renters navigating an uncertain path as the Atlantic boom unwinds. Number 8 brings the focus to the bigger picture, how 7 cities, each with their own story, found themselves swept up in a national rental market reversal. The sharpest clues lie in the timing and scale of policy shifts against a backdrop of historic apartment construction. Federal immigration targets, once set at over 1 million newcomers a year, were abruptly cut back in 2024, just as international student caps landed hardest in university cities like Saskatoon, London, and Halifax. These changes hit demand at the precise moment that a wave of new rental supply, planned years earlier, reached completion. Between 2023 and 2025, Canada added enough purpose-built rentals to expand the national stock by 10%, a pace not seen in decades. The result is a rare convergence. National vacancy rates climbed to 4.8% in 2024 and are projected to reach 5.8% by 2025, according to the Canada Mortgage and Housing Corporation. This marks a return to levels last seen before the pandemic rental boom, but the difference now is the sheer volume of empty units coming online. With more apartments available than at any time in recent memory, the leverage in the market has shifted. Rent growth, which averaged over 6% annually in the years prior, has collapsed to just 0.7%. By January 2026, the national average rent sits at $2,057, a 31-month low. For tenants, the landscape has changed dramatically. Incentives like free rent months and included utilities are now standard in listings, and negotiation is not just possible, but expected. Yet for small landlords, the story is more precarious. Many purchased or refinanced properties at the peak, assuming rents would only climb higher. Instead, they now face rising vacancies and stagnant or falling rents, while fixed costs like property taxes and maintenance remain stubbornly high. The cash flow squeeze is especially acute for those with variable rate mortgages or recent purchases, leaving some to cover hundreds of dollars in monthly shortfalls. Institutions with large portfolios can absorb the shock, but individual investors are left to navigate a market that no longer favors the owner. This national collision of policy and supply has created a market correction rather than a full-blown crisis, at least for now. But as the vacancy rate rises and rent growth stalls, the stakes are clear. Tenants finally have room to breathe, while landlords, especially small-scale players, are left wondering how long the downturn will last. The next chapters will be written not just by local fortunes, but by the pace of new construction, the direction of federal policy, and the willingness of both tenants and landlords to adapt to a rental market that looks very different from just a few years ago. Number 9 brings the focus to the personal stakes behind the rental downturn. Who stands to gain, and who faces real losses as rents slide and vacancies rise. For tenants, the power dynamic has shifted. After years of scrambling for scarce units and absorbing relentless rent hikes, Renters in these 7 cities now find themselves in a rare position to negotiate. Incentives like a free month's rent, included utilities, or reduced deposits have become commonplace, and listings that once sparked bidding wars now linger, giving tenants the leverage to shop around or push for better terms. Many are locking in more favorable leases or even moving to higher quality units at the same or lower price. For small landlords and individual investors, the mood is far less optimistic. Many bought properties during the boom, with mortgage payments calibrated to peak rents that are no longer attainable. The math is unforgiving. A typical investor with a $464,900 mortgage at 4.65% faces monthly payments of $2,623. Yet, average rents in many affected cities have dropped below $2,600. Add in property taxes, insurance, and maintenance, and the gap widens. Owners are left to cover hundreds of dollars out of pocket each month. The pressure is mounting further as new federal rules, in effect from 2026, reclassify these mortgages as income-producing residential real estate, triggering higher interest rates and tougher qualification standards. Institutional landlords with large portfolios can often absorb these shocks, but small-scale owners face difficult choices: cut rents, offer incentives, defer repairs, or exit the market entirely. For tenants, the immediate future brings more choice and negotiating power. For landlords, especially those with recent purchases, the correction feels less like a pause and more like a reckoning. As the landscape shifts, the winners and losers are being decided not by ideology, but by the hard realities of cash flow and bargaining power. Number 10 looks ahead to what comes next, as Canada's rental market stands at a crossroads. According to the latest CMHC forecasts, the national vacancy rate is expected to crest near 5.8% by 2025, marking the highest level in well over a decade. But this peak isn't expected to last. As the flood of new apartment completions slows sharply after 2026, many analysts predict that vacancies will begin to ease, setting the stage for a new cycle. The key variables to watch are clear: the pace of construction starts, net migration numbers, international student enrollments, and the direction of interest rates. If construction drops off as projected, potentially by 30 to 40% over the next 3 years, Canada could face a renewed shortage by the end of the decade, especially if immigration rebounds or student caps are relaxed. Conversely, if demand remains subdued and new supply keeps trickling in, the period of tenant leverage could stretch on, deepening the squeeze for small landlords. For both renters and property owners, the next 3 to 5 years will hinge on these moving parts. The market corrections seen in these 7 cities may prove temporary, or it could signal the start of a more volatile era where local booms and busts become the new normal. The indicators to watch aren't just headlines about average rents, but the underlying numbers, completions, migration flows, enrollment rates, and the cost of borrowing. Each will help determine whether this moment is a brief pause or the opening chapter of a much bigger shift in Canadian housing. Across all 7 cities, one pattern is clear. When surging supply collides with cooling demand, from immigration slowdowns, student caps, and remote work reversals, rental markets can flip fast. Tenants finally have leverage, even as small landlords face rising vacancies and shrinking margins. This isn't just a local dip, it's a sign that Canadian housing is entering a new, more unpredictable era. Which side of the shift are you on?